Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$8.66. That is exactly where Brand Engagement Network, ticker BNAI, closed the session on January 22nd, 2026. Now, if you were focused on the mega caps, you probably missed a staggering 600% explosion from its December lows of roughly $1.20. But let's be honest, the price is just the headline. The real story, the one we really need to dig into, is the volume. On January 21st alone, we saw 48.53 million shares trade hands. You have to compare that to their historical daily average of around 10 million. I mean, something has broken loose here.
Something is broken loose, or, something is just plain broken in the market structure. I'm going to stop you right there because citing the raw share count doesn't do justice to the absolute absurdity of the capital velocity we're seeing. Let's look at the dollar volume. On that single trading day, nearly $384 million worth of stock was traded. Now look at the company's market capitalization. Depending on how you count the fully diluted shares, the entire company is valued somewhere between $30 and $46 million.
It's a massive multiple.
It's not just massive, it's mathematical nonsense. It means the entire value of the company traded hands roughly 10 times over in a single 6.5-hour session. I mean, when you see dollar volume exceed market cap by a factor of 10, you are not looking at an investment thesis playing out. You are looking at a microstructure event. You are looking at a washing machine on spin cycle.
Okay, I see why you view it as mechanical chaos, and the velocity is certainly extreme. But I would frame it differently. I'd argue we're witnessing a violent but necessary repricing of a company that has executed a pivot the market completely ignored until now. So the central question isn't about the volume turnover. It's about the trigger. Is BNAI executing a brilliant sovereign AI arbitrage by moving into markets like Africa and Mexico? Or is this, as you're implying, a technically driven squeeze masking a company that is, essentially insolvent?
It is the latter, and dangerously so. We're talking about a going concern that, as of its last quarterly filing, had about $102,000 in cash. That isn't a corporate treasury, that's a luxury car payment. And yet the stock is behaving like it's the next NVIDIA.
Then let me establish the bull case, or what I'm calling the sovereign pivot. We have to look at the state of the AI market in 2026. The US layers, it's calcified. Google, Microsoft, OpenAI. They've won the platform war here. So if you're a microcap, you just cannot compete in the US. You have to go where the giants aren't. And BNAI has realized this. They're bypassing the US entirely to focus on sovereign AI in regulated markets. They're deploying engagement language models, ELMs, and RAG architecture in South Africa and Mexico.
Right, you're talking about geography, but are they actually deploying usable technology?
Absolutely. These are jurisdictions with strict data residency laws. You cannot just pipe patient data from Johannesburg into a ChatGPT server in Virginia. It violates local sovereignty. The deal with Valeo Technologies and the validation from a top 10 global pharmaceutical client prove the tech works for high-compliance industries. This price action, it's the market finally realizing that their strategy of investment as revenue is going to capitalize the balance sheet and save the shop.
And I'll be taking the bear case, the insolvency trap. I'm sorry, but I just don't buy the pivot narrative when the fundamentals are this catastrophic. We are talking about a company with an accumulated deficit of over $52 million. You mentioned the $102,000 in cash. That is less than a week of burn rate. This rally is purely mechanical. You have short interest at 41.57% of the float, a cost to borrow fee surging over 30%, and a float that was just decimated by a 1-for-10 reverse split in December. This created a low liquidity vacuum. So investors buying here at $8.66 aren't buying a business, they are buying a ticket to a squeeze that will end the moment the company prints shares to keep the lights on.
You're glossing over the catalyst that actually sparked this run, which is the Valeo Technologies deal in South Africa. This isn't just a press release, it's a structural innovation in how they are funding the company.
It's accounting gymnastics.
It's strategic financing. Let's look at the details. So BNAI entered a partnership with Valeo to deploy their AI for mental health screenings at Nelson Mandela University. Valio is putting up $2.05 million. But here's the key. Instead of booking that as an equity investment which sits passively on the balance sheet, BNAI structured it to be recognized as licensing revenue for their IP.
Which is exactly why listeners need to be careful.
It hits the top line. It provides immediate, non-dilutive capital to the income statement. It shows growth.
It shows artificial growth. I mean, let's explain this clearly. Standard GAAP accounting separates capital injection from revenue for a reason. Revenue is supposed to represent the recurring value your product creates. Investment is cash you take in to build the product. By labeling an equity investment as licensing revenue, they are frankly tricking the algorithms. They are telling the quants, look, our revenue just exploded, when in reality they just sold a chunk of the future economics to get cash in the door.
But cash is cash. Whether it's labeled revenue or equity investment, that $2.05 million is real money they can use to pay developers.
It's a one-time sugar high. That $2.05 million is a lump sum. Once that burns, and with a $52 million deficit, it will burn fast. What's left? You're left with a 35% revenue share on a mental health app in a university setting. That is entirely speculative. You can't run a NASDAQ-listed company on a 35% cut of a pilot program. You're celebrating a loophole, not a business model.
I think you're missing the strategic alignment, though. The sovereign aspect is what makes this stick. South Africa has POPIA, the Protection of Personal Information Act. It's their version of GDPR. It is incredibly strict about cross-border data transfer. BNAI's architecture is closed loop. The data stays in the jurisdiction. That $2 million validates that the sovereign use case is worth paying for. If they can replicate this model in Mexico, in Indonesia, in Brazil, suddenly that accounting trick becomes a blueprint for non-dilutive financing globally.
If they can replicate it, that's the gamble. But let's pivot to the mechanics, because I maintain that the fundamentals of the South African deal are not what pushed this stock from $1 to $8. It's the plumbing of the market. We need to talk about where this volume is actually happening.
You're referring to the dark pools.
I am. 55.69% of the volume on this rally is occurring in dark pools, off-exchange venues, which is, fairly typical for high volatility events. When volume spikes, institutional venues absorb the overflow. Not to this extent. When you have nearly 56% of volume off-exchange, it suggests heavy institutional internalization of retail flow. Here's what that means. Retail traders on their apps are hitting buy. Wholesalers, the market makers, are filling those orders internally from their own inventory instead of sending them to the lit market right away. This creates a massive distortion. It lets the market makers manage the price action to some degree. But when you combine it with the short interest, it's a powder keg.
Okay, so explain the short interest dynamic here, because 41% is high, but we've seen higher.
We are looking at 41% of the float sold short. The cost to borrow is 30.6%. That is a massive negative carry. Every single day the stock doesn't drop, shorts are bleeding money just to hold the position.
I acknowledge the volatility is extreme, but I would argue this is a price discovery phase. You mentioned the short interest as a trap, but it can also be fuel. If the thesis is correct that BNAI has found a profitable niche, then those shorts are just wrong. And when 41% of the float has to cover, that demand is real, regardless of whether it's technical or fundamental.
That's a compelling argument, but have you looked at the days to cover metric? It looks low right now, 0.16 days, but that's only because the volume is 48 million shares a day. That is a mirage. If liquidity dries up, if the volume drops back to its historical 10 million, the days to cover spikes instantly. Those shorts aren't just wrong, they become trapped in an illiquid room with a very small door. The days to cover metric is currently distorted by this manic, high-frequency churning.
Let's talk about the balance sheet then, because you said they are insolvent. I think you're ignoring the liability management they executed in Q4 of 2025. They reduced liabilities by about $2.5 million through debt for equity swaps. That cleans up the ledger. It shows management is actively fixing the capital structure to avoid that bankruptcy risk you're so focused on.
They cleaned it up, yes, but at what price? And who benefited? The conversion price for those swaps was $2.10. The stock is at $8.66. You do the math.
It's a 4x return.
Exactly. Those creditors who swap debt for equity are sitting on a 400% gain in a matter of weeks. They are not long-term believers in sovereign AI. They are creditors who want their money back. And they are likely the ones feeding this wall of supply into the rally.
But that supply is being absorbed. That is my point. The stock is holding 866 despite that potential selling pressure.
For now. But it's not just creditors selling. Let's talk insiders. The people who actually know the status of the tech. The SVP of Engineering, Pinam Venkatarama, sold stock in mid-December at around $2.60.
That was before the breakout and before the Valio confirmation.
If the senior vice president of engineering didn't see value at $260, why should a retail investor see value at $866? I mean, there hasn't been any open market buying from insiders to support this. It's a massive signal. If the tech was truly about to revolutionize mental health in Africa, he wouldn't be selling at the lows.
I'm not convinced by that because insiders sell for many reasons. Taxes, liquidity, diversification. It doesn't always signal a lack of faith. Plus, the leadership situation is stabilizing. We have an acting CEO, Tyler Luck, who is a co-founder. He knows the product, and more importantly, the capital raise window is now wide open. They have an active S3 shelf registration. You view dilution as a death knell. I see it as a lifeline.
A lifeline for the company, maybe, but an anchor for the stock price.
No. Think about it. If they execute an at-the-market offering right now at these elevated prices, they can raise $10 or $20 million with minimal dilution compared to when the stock was at $1. If they sell 2 million shares at $8.50, they raise $17 million. That cash eliminates the going concern risk overnight. It completely transforms the balance sheet.
That is the definition of the greater fool theory. You are hoping they sell stock to new investors to pay off the debts of the old business model. But let's go back to the product viability, specifically the peer comparison. We need to see who they are actually competing with. You mentioned the pharma deal.
Yes, a top 10 global pharmaceutical client, a $250,000 development service contract.
$250,000 is a rounding error. It's a consulting gig.
It is the seal of approval. Pharma has the strictest compliance rules on the planet. If BNAI's LM and Ragstech pass their InfoSec audit, that is a competitive moat. It positions them similarly to Big Bear AI, ticker BBAI. Big Bear does government work, intelligence work. They trade on the security premium. BNAI is the Big Bear of the emerging markets.
I come at it from a different angle. I look at SoundHound AI, ticker SOUN. SoundHound has real scaling revenue, a $4.6 billion market cap, and widespread automotive adoption. BNAI is being traded in sympathy with SOUN because the algorithms see AI and voice and just bid it up. But the tech is different. SoundHound is pure voice assistance. BNAI is trying to do this avatar-based engagement.
Which is higher value.
Is it, or is it just higher friction? But look at another peer, LivePerson, ticker LPSN. They are a distressed asset in the customer support space. Their market cap is around $30 million, similar to where BNAI was before this madness. Yet BNAI trades at this massive premium solely because of the AI narrative wrapper. It's detached from the reality of its peers. LivePerson has tens of millions in revenue and is struggling. BNAI has $100,000 in cash and is soaring. That is a disconnect.
But the narrative matters. You have to look at the macro environment. You can't analyze this stock in a vacuum. Look at Polymarket. As of January 2026, the probability of an AI bubble bursting is rated between 4 and 18%. The market believes the trend is durable.
Prediction markets are not fundamental analysis.
They are sentiment analysis, and sentiment drives multiples. Plus, Polymarket traders are predicting interest rate cuts in 2026. Lower rates disproportionately benefit growth stocks with distant cash flows. BNAI is a high beta proxy for this entire sector. If you believe the AI trade has legs, BNAI is the catch-up trade. It's the highest leverage way to play the sector.
Being a high beta proxy works both ways, though. If that Polymarket probability ticks up, if we get one bad regulatory ruling or one failed model, BNAI goes to zero first. It is the weakest link in the chain. And frankly, relying on prediction markets to justify a valuation of 10 times dollar volume turnover is risky business.
But that risk is priced in. That is why it was at $1. The repricing to $8 reflects the fact that they might actually pull this off. They have the tech,
They have the sovereign niche, which no big player is touching, and they have the creative financing to bridge the gap.
Let's dig a little deeper on the sovereign niche, because I think you are overestimating the defensive moat there. You mentioned BigBear.ai earlier. They have government contracts with the U.S. Department of Defense. That is sticky revenue. BNAI has a pilot program with a university in South Africa. The switching costs are low. If a local competitor in Cape Town spins up in Llama 3 model and wraps it in a privacy layer, what stops them from eating BNAI's lunch?
Did engagement data. That's the engagement and brand engagement network. Their claim is that the avatar, the visual AI assistant, creates higher completion rates for things like health screenings. If the Nelson Mandela University pilot proves that students are 40% more likely to finish a depression screening with the avatar versus a text bot, that is proprietary data. You can't just fork that on GitHub. That becomes the moat.
And that is the show me story. But right now, we are paying a premium for data that doesn't exist yet. We are paying for the hope of data. And while we wait for that data, the company is burning cash it doesn't have. Which brings us right back to the immediate threat, the S3 shelf registration.
The ATM.
The at-the-market offering. We touched on this, but let's be very specific about the mechanism. An ATM allows the company to trickle shares into the market at current prices. If I am the CFO of BNNI and I see my stock up 600% on 48 million in volume, I am hitting the sell button every single minute of the trading day. I am feeding that retail demand with fresh paper.
And you should. That is your fiduciary duty to the company's survival.
Exactly. But that means every buyer at 866 is effectively buying stock directly from the company, which is diluting the value of the share they just bought. It's a paradox. The only way the company survives is by selling stock, which makes the stock worth less. It's a classic death spiral financing structure, disguised as a growth opportunity.
I disagree with death spiral. A death spiral is when you sell stock at a discount to the market price, forcing the price down. An ATM sells at the market price. If the market is voracious, if there are 48 million shares of demand, the market can absorb 2 million shares of dilution without blinking. We saw GameStop do this. We saw AMC do this. They capitalized the business on the backs of the squeeze. BNAI is just following that playbook.
Comparing BNAI to GameStop is ambitious. GameStop had a global retail army. BNAI has a momentary flicker of attention on a microcap screen. The moment the volume fades, the ability to raise cash fades. And if they haven't filled the bank account by then, the going concern warning becomes a bankruptcy filing.
Okay, but look at the business relation aspect again. You mentioned SoundHound. There is talk, and this is speculative, I admit, but it's out there, that these sovereign players are acquisition targets. If a major U.S. player wants into the African market but can't deal with the data sovereignty issues, buying a BNA is a shortcut.
Now who's speculating?
It is a rational consolidation play. Why build a compliance stack for South Africa from scratch when you can buy one for $40 million?
Because for $40 million, you get a company with $52 million in accumulated deficit and $102,000 in cash. You're buying a liability, not an asset. If I'm Microsoft or Google, I'm not buying BNA. I'm hiring 3 lawyers and a developer in Cape Town and building it myself. The acquisition premium is a fantasy used to lure retail investors in at the top.
I think you underestimate the difficulty of the last mile in these markets. It isn't just code, it's relationships. It's the deal with Valio. It's the deal with the pharma giant. Those are entrenched relationships.
A $250,000 contract is not an entrenched relationship. It's a test drive. And historically, most test drives in the microcap AI space end with the car being returned to the lot.
All right, let's bring this to a close. We have laid out 2 very different realities for brand engagement network. We're looking at the same ticker, the same price, but 2 different worlds.
Indeed.
From my perspective, BNI is a high-risk, high-reward bet on the sovereign AI narrative. They are doing what a microcap should do, pivot away from competition and into a niche. The Valio deal, while creative accounting puts numbers on the board and proves the model, the pharma deal proves the tech is safe and compliant. If management is smart, and the debt swap suggests they are using this volume to capitalize the balance sheet right now,
If they succeed, the turnaround becomes real, and today's price might actually be a floor.
And my summary is, well, it's stark. The going concern risk is the reality. This stock has detached from fundamentals. Investors buying here are not investing in South African mental health AI. They are participating in a crowded, dangerous short squeeze. The wall of supply from the $2.10 debt converters is looming, insiders have sold, and the inevitable dilution from that S3 shelf is going to crush the share price back down. You are buying a trading vehicle, not a company. And when the music stops, there won't be enough chairs.
It seems we agree on one thing then. BNAI serves as the perfect proxy for this specific moment in the market. It is a collision between genuine technological potential in niche markets and extreme, almost violent financial engineering in the microcap space.
On that, we certainly agree. Whether the sovereign narrative justifies the premium, well, the market will decide that very, very quickly.
And we'll be watching the tape. That's it for this debate.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!